You want life insurance. You're confused. There are just too many insurance companies and too many types of insurances out there. Also, you just can't seem to run away from that persistent agent that is telling you that he has the best insurance for you and that all other insurances are trash. If you find yourself in this awkward position, you are at the right place. Fret no more. In this video, I will compare and contrast term life insurance and permanent life insurance. Stay tuned. Hi teasers, my name is Linda, your money teaser. Here, I give money teasers on personal finances so that you and I can arouse our dreams. Today, I will talk about the difference between term life insurance and permanent life insurance. And by the end of this video, you will have a basic understanding of both plans so that you can do an educated choice for you and your family. Let's get started. Before you buy life insurance, you should do your homework. It is very important you understand the purpose of life insurance before you start looking into which plan is most suitable for you. Moreover, you need to know how much life insurance you need to be adequately insured and the things that will affect your insurability and quote. If you still have some of these questions unanswered, please watch my video on life insurance in simple terms, which explains what life insurance is, the application process, and the things that affect your insurability and quote. Once you have the basic understanding of the purpose of life insurance, you can now look into the life insurance policy that is suitable for you and your family. And this task can be very daunting because there are hundreds of life insurance companies out there with a wide variety of plans. Hence, the purpose of this video, to explain the difference between term life insurance and permanent life insurance in simple terms. To achieve this task, I will use what I refer to as the 4 C's of life insurance, which are coverage, cost, cash value, and contributions. I will use these 4 C's to differentiate between term life insurance and permanent life insurance. But before I talk about the first C of life insurance, I would like to briefly discuss underwriting, which I find to be very important to understand, especially if you are taking a private insurance policy. As I had mentioned in one of my videos, life insurance, like any other type of insurance, is a transfer of risk. By signing up for life insurance, you transfer the risk of not being there to care for your family financially after death onto the life insurance company that will pay the death benefit to your family so that your family will continue to maintain the same lifestyle you gave them. As a result, insurance companies will want to evaluate the level of risk you would bring to them before they can insure you. This is where underwriting plays an important role. Underwriting is the process that life insurance companies use to assess your risk classification. During this process, the underwriter uses the information you provided in your life insurance application to assess your risk. Some of the information they look into are your family history, your medical history, and the results of your medical examination if you were ordered to have one. The underwriter will also look into your age, your gender, your occupation, your lifestyle, and your hobbies, just to name a few. After all this information are collected, the underwriter uses them to determine your risk classification, which in turn determines your premium. The process of underwriting is very important because it determines the most accurate premium for you based on your situation. I will cover underwriter in details in a different video. Now that we have an idea of what underwriting is all about, let's start with the first C of life insurance, your coverage. Just as the name implies, Term insurance insures you for a limited duration, meaning it expires. For as long as you keep up with your premiums throughout the term of your contract, the life insurance company will usually pay the death benefit if you die during the time your policy is active or in force. However, if you survive your policy, you lose coverage. You can get a term policies in two ways. You can get it through your employer. In this case, the duration of your contract is 1 year, renewable during open enrollment. Open enrollment is a time period of the year during which employees are allowed to sign up for their benefits through the company. Besides the group term insurance that you get through your employer, you can also get a private term insurance policy. In this case, rather than going through your employer to get insurance, you go directly to the life insurance company to get your life insurance policy. Unlike group term life insurance that is only acquired during open enrollment, private term insurance, on the other hand, can be acquired at any time. Most of the time, you will have to talk to a life insurance agent that will assist you to get your policy. A key difference to note between the group term life insurance and the private term insurance is the fact that, unlike private term insurances that are usually overwritten, group term insurances, on the other hand, are not underwritten. Meaning, your premiums will not be determined based on your health and lifestyle. This is a great benefit for those with medical conditions. Concerning private term life insurance, you can get contracts of 10 years, 15 years, 20 years, 25 years, 30 years, and sometimes 35 years, depending on the company offering you insurance. As I said earlier, term insurance expires. For example, if you are 30 years old and you take a 20-year term policy, it will last for 20 years and will expire when you turn 50. In this case, after 20 years, you won't have insurance anymore. And if you're still in need of life insurance at that time, you could either sign up for a new policy and go through the process of underwriting all over, or you can renew the expired policy for an annual renewable term policy, meaning your premiums will increase every year from that point onward. Keep in mind, annual renewable term rates are more expensive than level term insurance rates, because each time you decide to bypass the process of underwriting, expect your premiums to be higher. A good question to ask at this point will be to know what will happen to all the premiums you've paid into a term policy throughout the years. To answer this question, think of life insurance like car insurance. You hope to keep on paying insurance on something you don't ever wish to use. The good thing with life insurance, though, is the fact that you can get your premiums refunded after your contract expires. But it comes at a cost. You must sign up for the return of premium riders if you want your premiums refunded, or else your premiums won't be refunded, just as with the car insurance you have. If you want your premium refunded, make sure the insurance company you choose has the return of premium rider. What about the coverage of a permanent life insurance? Unlike the term life insurance that lapses, the permanent life insurance does not lapse, but it must be planned properly. Permanent life insurance includes whole life insurance and universal life insurance. Whole life insurance provides some guarantees that universal life insurance does not. One of those guarantees with whole life insurance is your coverage for life or till the age of 100 for as long as you pay your premiums. Though the purpose of universal life insurance is to insure you for life, it does not guarantee you coverage for life or till the age of 100 as the whole life insurance does. With universal life insurance, you have a risk of losing your policy if it is not planned properly. Make sure to talk to an experienced agent if you are interested in a universal life insurance policy. Now, let's talk about the second C of life insurance, the cost. The cost of life insurance heavily depends on your risk classification obtained during the process of underwriting. For most insurances, Once your risk classification is determined, your premiums are locked in place for as long as your contract is valid. For example, if you sign up for permanent life insurance today and you are told to pay $200 per month, you will maintain the same premiums of $200 per month for the rest of your life. Likewise, if you sign up for a 30-year level term life insurance and your premiums are set to $25 per month, you will pay $25 every month for the next 30 years of your policy until your policy expires. The cost will also depend on the type of life insurance you want. For example, compared to permanent life insurance, term insurances are the most affordable of all insurance policies. The low cost of term insurance is due to the fact that it is temporary. Hence, everything you pay as premium is put toward the cost of insurance. But keep in mind that the cost of the term insurance will increase upon renewal. This means that once your term insurance expires, you will not pay the same premiums for the same amount of insurance if you choose to renew it. As a matter of fact, the cost of insurance will increase by a factor of 3 to 5 after 20 years. And the longer the time, the higher your premiums, because age is a big factor in determining premiums. Let's take an example. You are paying $25 per month on a 20-year term policy. 20 years after, your premium will increase to about $75 to $125 per month for the same policy. Permanent life insurances, on the other hand, are usually costly. The cost of permanent insurance can be as much as 5 to 15 times the cost of term insurance. For example, if you are paying $25 per month on a term policy, expect to pay anywhere between $125 to $375 on a permanent life insurance for the same death benefit. Here is why permanent insurance is more costly than term insurance. The premiums of a permanent life insurance are split in two. Depending on your risk classification, a portion of the premiums will go toward the cost of insurance, just as with the term insurance. And the other portion of your premiums will go into the cash value. This is the reason why permanent life insurances are also called cash value insurances, regardless of its type. This leads us to the third C of life insurance, the cash value. Cash value is a tax advantage account that is set up within your insurance policy that accumulates money over time. The rate at which this account accrues interest depends on the type of permanent life insurance you signed up for. For example, with term insurances, you have no cash value because all your premiums go toward the cost of insurance. With whole life insurance, the cash value grows at a guaranteed fixed rate, usually between 2 to 4%. With universal life insurance, the cash value is market sensitive, meaning it grows based upon the performance of the market. With variable universal life insurance, you choose how to invest the cash value from a set of options similar to mutual funds. With index universal life, the cash value is tied to the performance of an index of economy, such as the S&P 500. One thing worth mentioning here about cash value is the fact that it is separate from the death benefit and can be accessed by the owner of the life insurance policy. Depending on the type of the permanent life insurance you have, cash value can be accessed differently. It can be accessed through withdrawals. In this case, the money put into the plan as contributions can be taken out. The cash value can also be accessed through loans. If you choose this option, keep in mind your death benefit will act as a collateral to the loan and interest on the loan. Cash value can be accessed through the cancellation or surrender of the policy. Here, the money you get is the cash value minus the surrender fees. With whole life insurance, the policy can be canceled and the cash value can be used to buy a new fully paid up life insurance policy. And with universal life insurance, cash value can be used to pay the premiums of the insurance policy. Now let's talk about the fourth C of life insurance, the contributions. Your premium contribution depends on the type of life insurance plan you have. For group term life insurance, your contributions are deducted from your paycheck every time you get paid. For as long as you work for your employer, you will pay the same insurance until the end of the year when the insurance expires. And if you're still interested in group term insurance, you will have to renew your contract every year during your company's open enrollment. Keep in mind, your premium will increase every year. Another thing worth mentioning about group life insurance is the fact that some employers might pay for your contribution as a benefit of you working for the company. If this is your case, your employer will also give you the opportunity to buy additional life insurance if you need more coverage. Concerning private term insurance, you get to choose the frequency at which you will want to pay for your premiums. The options available are monthly, quarterly, biannual, or annual contributions. It is important to reiterate that with term life insurance, you will pay your premiums up to the term of the contract. For example, with a 30-year term life insurance contract, you either contribute for 30 years or till you pass away, whichever comes first. Keep in mind, your contributions might vary depending on the type of private term insurance you have. For example, if you sign up for an increasing term insurance, your premium and death benefit will increase every year. If you sign up for a decreasing term insurance, your premium will remain the same while your death benefit will decrease every year. And if you sign up for a level term insurance, your premiums and death benefit will not change for as long as you keep the policy active. Level term insurance is the most common type of life insurance. It is wise to make sure you know the type of term insurance you're getting in order to prevent unpleasant surprises. I mentioned earlier that permanent insurance, also called cash value insurance, can be subcategorized in two: whole life insurance and universal life insurance. Each one of these two subcategories can be broken down even further. The difference among the permanent life insurance policies lies mostly on how the cash value accrues interest and how the contributions are made or can be made into these plans. I've already talked about how cash value grows with each permanent insurance. Now, I will talk about how the contributions are made into these permanent insurance plans. With whole life insurance, contributions are guaranteed, meaning if the insurance company asks you to pay $200 per month, it is exactly what you would pay every month. You cannot pay more, nor can you pay less. Another thing you should know about whole life insurance is the fact that it matures at 100, meaning if you are blessed to live to be 100 years old, the death benefit will be paid to you at the moment you turn 100 years old. But you must pay your premium every year for as long as you are alive till 100. If you don't desire to pay your premiums for life or till age 100, you can opt for a paid-up life insurance policy. In this case, rather than paying until death or until the age of 100, you get to choose to pay up your policy in a given amount of time. For example, you can decide to pay your whole life insurance premiums in 20 years. In this case, we talk of a 20-pay whole life insurance. This simply means that instead of paying your premiums for life, you get the opportunity to pay off your policy in 20 years while you are insured for the rest of your life. Keep in mind though, paid-up policies are more costly than the traditional whole life policies. What about universal life insurance contributions? Unlike whole life insurance with guaranteed contributions, universal life insurance contributions are flexible. With a universal life insurance, minimum and maximum contributions are set for your plans, and you are only allowed to pay premiums within these limits. For example, if the universal life insurance asks you to pay $200 per month on a policy with a minimum of $170 and a maximum of $450, you have the flexibility to pay anywhere between $170 and $450 per month. The reason why people might pay more than the required premiums per month is to have the excess contribution grow into the cash value. Those that paid less than the required premiums are usually those that are facing financial challenges at some point in their lives. Likewise, universal life insurance gives you the ability to use your cash value to pay for your premiums, something you cannot do with a whole life insurance policy. With this flexibility, rather than paying premiums for life, you can plan to contribute during a given time frame and stop. But you have to be careful stopping your contributions into a universal life insurance, because unlike whole life insurance, you can lose your coverage with universal life insurance. Hence, those that usually stop paying premiums usually contribute more than the required premium in order to allow the cash value to grow even faster to cover for the future cost of insurance. Moreover, unlike the whole life insurance that matures at 100, most universal life insurances mature at 120. Meaning, if you can live to be up to 120 years, the death benefit will be paid to you and the cash value as well, depending on how your plan was structured. Teasers, we have come to the end of this video. You now have a better understanding of the different types of life insurances. If there is one thing to retain of this video, make sure you know and understand the type of life insurance you have or are planning to get. If this video has been of any value to you, please don't forget to like, share, and subscribe. Also, let me know in the comments if you have any questions. See you in the next video.